A dividend is a distribution of profits by a corporation to its shareholders, after which the stock exchange decreases the price of the stock by the dividend to remove volatility. The market has no control over the stock price on open on the ex-dividend date, though more often than not it may open higher. When a corporation earns a profit or surplus, it is able to pay a portion of the profit as a dividend to shareholders. Any amount not distributed is taken to be reinvested in the business, called retained earnings. The current year profit as well as the retained earnings of previous years are available for distribution. A corporation is usually prohibited from paying a dividend out of its capital. Distribution to shareholders may be in cash, usually by bank transfer, or, if the corporation has a dividend reinvestment plan, the amount can be paid by the issue of further shares or by share repurchase. In some cases, the distribution may be of assets. The dividend received by a shareholder is income of the shareholder and may be subject to income tax, see dividend tax. The tax treatment of this income varies considerably between jurisdictions. The corporation does not receive a tax deduction for the dividends it pays. A dividend is allocated as a fixed amount per share, with shareholders receiving a dividend in proportion to their shareholding. Dividends can provide at least temporarily stable income and raise morale among shareholders, but are not guaranteed to continue. For the joint stock company, paying dividends is not an expense, rather, it is the division of after-tax profits among shareholders. Retained earnings, profits that have not been distributed as dividends, are shown in the shareholders' equity section on the company's balance sheet, the same as its issued share capital. Public companies usually pay dividends on a fixed schedule, but may cancel a scheduled dividend, or declare an unscheduled dividend at any time, sometimes called a special dividend to distinguish it from the regular dividends. More usually a special dividend is paid at the same time as the regular dividend, but for a one-off higher amount. Cooperatives, on the other hand, allocate dividends according to members' activity, so their dividends are often considered to be a pre-tax expense. Dividends are periodic payments made to shareholders from corporate profits. These payments can make a stock more attractive to investors, but it may also signal that a company isn't doing enough to generate better returns. Dividends are a percentage of a company's earnings paid to its shareholders as their share of the profits. Dividends are generally paid quarterly, with the amount decided by the board of directors based on the company's most recent earnings. Dividends may be paid in cash or additional shares. When a company announces a dividend, it also announces the payment date on which the dividend will be paid into the shareholders' accounts. Dividends are payments companies make to reward their shareholders for holding onto their stock. They represent a portion of a company's profit and can be paid in cash, stock, or some other property. When a company announces a dividend, it's agreeing to pay a certain amount per share of stock at a certain point in time. Hence the meaning of the phrase paying dividends. Who pays dividends? Companies that offer a dividend payout tend to be larger, more established companies with proven track records of reliable growth and stock that doesn't fluctuate widely. In some cases, a high dividend may mean the company is in distress and is trying to attract investors. However, not every public company pays dividends, in fact, most don't. Rather than distribute portions of the profit they make to shareholders, non-dividend paying companies may choose to retain all of the income they make and invest it back into the business to fund growth or build value. That's often the case with startups or companies in the high-tech or biotech fields that have higher growth potential and require further capital to fuel it. Keep in mind that just because a company issues a dividend payout or has in the past doesn't mean it will always do so. It's conceivable that, since dividends are paid from profits, a company having financial difficulties could choose to greatly reduce dividends or even choose not to pay them at all. How could dividend stocks help you? There are some great advantages to investing in dividend stocks, including additional income. Dividends allow you to get additional return on your investments by generating income. For those living in retirement, that income can be a powerful benefit. Portfolio growth. You also have the option to reinvest dividends instead of receiving payouts, allowing you to increase shares and build your portfolio. Manage stock market volatility. In general, stocks that pay dividends are less volatile and have historically performed well. How are dividends calculated? The dividends paid to you depend on two factors: the number of shares you own, the amount of profit the company will share in dividends. Companies that announce dividends do so as either a percentage or a dollar amount. If a company announces a dividend as a dollar amount, the dividend is calculated by multiplying the number of shares you own by the amount of the dividend paid. So if you own 1,000 shares of a company, and that company pays a dividend per share of 68 cents, you would be paid $668. The amount a company pays in dividends is measured by the target payout ratio, which is a percentage calculated by dividing the dividends paid over a period by the company's net income. For example, if a company pays $20,000 in dividends, but earned $100,000 in total net income, the target payout ratio would be 20%. Another important calculation in understanding dividends is the dividend yield, which is the ratio of a company's annual dividend relative to the share price at a particular point in time. So if a company announces that it will have an annual dividend of 20 cents per share, and the stock is trading at $50, the dividend yield would be 4%. The dividend yield can be a valuable measure to help you evaluate and compare dividend stocks when making investment decisions. When are stock dividends paid? Most dividends are paid on a quarterly or annual basis, though some are paid monthly or biannually. Companies may also announce special dividends that are declared at a certain time, like when a company has excess income. When a company pays cash dividends, they send the money to a shareholder's brokerage account. Some companies may choose to pay dividends in the form of stock or other property. If a company declares a dividend for a stock you own, it's important to pay attention to the ex-dividend date. This is the date by which you would have had to own the stock in order to receive the dividend. If you purchased a stock on the ex-dividend date or later, you would not be eligible to receive the dividend. Ready to see where dividends fit into your investment story? Dividends can be a great way to generate investment income and build your investment portfolio. Of course, as with any type of investment, it's important to review your goals, time frame, and needs to ensure you're making the right decisions for you. A dividend is a reward paid to the shareholders for their investment in a company, and it's usually paid out of the company's net profits. Some companies continue to make dividend payments even when their profits don't justify the expense. A steady track record of paying dividends makes stocks more attractive to investors. Various mutual funds and exchange-traded funds, ETFs, also pay dividends. Dividends, for stocks, must be approved by the company's board of directors. In some cases, they also require shareholder approval. Point 1 for funds, the fund managers award dividends based on the fund's net asset value, NAV, and whether the fund receives dividends. Although cash dividends are common, dividends can also be issued as shares of stock. Fast fact: a stock's dividend yield is the dividend paid per share and is expressed as a percentage of the company's share price, such as 2.5%. Who gets dividends and how? Common stock shareholders of dividend-paying companies are eligible to receive a distribution as long as they own the stock before the ex-dividend date. This is essentially a cut-off date for assigning the dividend payment when shares change hands. Dividends are paid on a schedule set by the board. They may be paid monthly, quarterly, or annually. Companies can also issue non-recurring special dividends, either individually or in addition to a scheduled dividend. Fast fact: not all companies pay dividends to the owners of common shares, but owners of preferred shares are guaranteed a set dividend payment. Dividend-paying companies. Larger, established companies with predictable profits are often the best dividend payers. Companies within the following industry sectors maintain a regular record of dividend payments: basic materials, oil and gas, banks and financial, healthcare and pharmaceuticals, utilities. Companies structured as master limited partnerships, MLPs, and real estate investment trusts, REITs, are required to make specified distributions to their shareholders. Point 23. Funds may also issue regular dividend payments as stated in their investment objectives. Who doesn't pay a dividend? Young, fast-growing companies, such as those in the technology and biotechnology sectors, might not pay regular dividends since they may be in the early stages of development and are retaining all of their earnings for research and development, business expansion, or operational activities. Investors tend to forgive the lack of a dividend if the company's stock price is growing rapidly. Not surprisingly, once a company begins paying dividends, it's typically difficult to reduce or suspend the payments. Doing so is generally viewed by investors as a sign of falling profits, not to mention a loss of income. Important dividend dates. Dividend payments follow a chronological order of events, and the associated dates are important in determining which shareholders qualify to receive the dividend payment. Announcement date. Dividends are announced by company management on the announcement date, or declaration date, and must be approved by the shareholders before they can be paid. Ex-dividend date. The date on which the dividend eligibility expires is called the ex-dividend date or simply the ex-date. For instance, if a stock has an ex-date of Monday, May 5th, shareholders who buy the stock on or after that day will not qualify to receive the dividend. Shareholders who own the stock one business day prior to the ex-date, i.e., Friday, May 2nd, or earlier qualify for the distribution. Record date. The record date is the cut-off date, established by the company to determine which shareholders are eligible to receive a dividend or distribution. Payment date. The company issues the dividend payment on the payment date, which is when the money is credited to investors' accounts. Point 45. How do dividends affect a stock's share price? A stock's share price may change to reflect a dividend payment. For example, assume a company trading at $60 per share declares a $2 dividend. As the news becomes public, the share price may increase by $2 and hit $62. The stock might trade at $63 one business day before the ex-dividend date. On the ex-dividend date, its price will likely fall below its previous price at the start of the trading session, as anyone buying on the ex-dividend date won't receive the dividend. Why do companies pay dividends? Many investors buy stocks for their dividends rather than their share price growth potential. Some extraordinarily successful companies like Coca-Cola Co. are prized more by investors for their steady dividends than for their potential price growth. Dividends are often expected by shareholders as their share of the company's profits. Dividend payments reflect positively on a company and help maintain investors' trust. A high-value dividend declaration can indicate that a company's doing well and has generated good profits. However, some may interpret it as an indication that the company doesn't have much going on in the way of new projects to generate better returns in the future. The company may appear to be prioritizing shareholder payments over reinvesting its earnings into further growth. A company with a long history of dividend payments that declares a reduction or elimination of its dividend typically signals trouble. However, a dividend cut doesn't necessarily translate into bad news. The company's management may have a plan for investing the money in a high-return project that could magnify returns for shareholders in the long run. Fund dividends. Dividends paid by funds are different from dividends paid by companies. Funds employ the principle of NAV, which reflects the valuation of their holdings or the price of the assets a fund has in its portfolio. Point 6. Regular dividend payments shouldn't be misread as a stellar performance by the fund. For example, a bond investing fund may pay monthly dividends because it receives monthly interest on its interest-bearing holdings, and it merely transfers all or a portion of the interest income to the fund's investors. A stock investing fund pays dividends from the earnings received from the many stocks held in its portfolio or by selling a certain share of stocks and distributing capital gains. Are dividends irrelevant? Economists Merton Miller and Franco Modigliani argued that a company's dividend policy is irrelevant and has no effect on its stock price or cost of capital. A shareholder may be indifferent to a company's dividend policy, especially if the dividend is used to buy more shares. If a dividend payout is seen as inadequate, an investor can sell shares to generate cash. In either case, the combination of the value of an investment in the company and the cash they hold will remain the same. Miller and Modigliani thus conclude that dividends are irrelevant, and investors shouldn't care about the firm's dividend policy because they can create their own synthetically. Point 7. This argument has done little to persuade the many investors who consider dividends an attractive investment incentive. How to buy dividend-paying investments. Investors seeking dividend investments have several options, including stocks, mutual funds, and ETFs. The dividend discount or Gordon growth models can help investors choose individual stocks. These techniques rely on anticipated future dividend streams to value shares. To compare multiple stocks based on their dividend payment performance, investors can use the dividend yield factor, which measures the dividend in terms of a percentage of the current market price of the company's share. How to measure dividends. The dividend rate can be quoted in terms of the dollar amount each share receives as dividends per share, DPS. In addition to dividend yield, another important performance measure to assess the returns generated from a particular investment is the total return factor. This figure accounts for interest, dividends, and increases in share price, among other capital gains. Tax is another important consideration when investing in dividend gains. Investors in high tax brackets often prefer dividend-paying stocks if their jurisdiction allows zero or comparatively lower tax on dividends. What is a dividend in business? Dividends are business profits shared with and divided between investors. Are dividends free money? Dividends signal that a company has stable cash flow and is generating enough profits to provide investors with income. Because you need to purchase a stock or fund that pays dividends, and since dividends are subject to taxes, they aren't free. What is an example of a dividend? A company's board of directors may decide to issue an annual 5% dividend per share, DPS. If the company's shares are worth $100, then the dividend is $5. If the dividends are issued every quarter, each distribution is $1.25. The bottom line. Dividends are seen by many investors as a sign that a company is earning a healthy profit and, more to the point, is willing to share it with its investors. Not all companies pay dividends, and not all investors care about them. If you do, then it's important to shop around for the best dividend-paying stocks for your money. Dividend investing is an investment style that prefers stocks which pay a dividend. Dividend-paying stocks may be preferred because of a desire by investors for cash flow or because companies which pay dividends may tend to be large and relatively stable. Dividend investment as a style has been criticized as irrational, because when a company pays a dividend its stock price should fall by an equivalent amount. Companies can also return cash to shareholders through stock buybacks, or retain and reinvest it. Investors should instead look at the total return of a stock. Stocks which pay dividends may receive less favorable tax treatment. Dividend stocks tend to be exposed to the value, profitability, and investment factors, which explains outperformance. Thank you for watching this video.